Hello there. In this learning module, you will learn to prepare 3 of the 4 financial statements. You will use the knowledge of these financial statements throughout the rest of the semester. They're a very key part to learning accounting. So let's go ahead and begin. One of the first questions that's asked of any business is, how much money did they make? Or in accounting terms, how profitable are they? Everybody wants to know that when you're taking a look at a business. And so accounting provides those answers for us. So the first statement that we're going to go ahead and take a look at is what we call the income statement. It's not only the first statement we're going to look at, it's also the first statement that you prepare in the series of the 3 financial statements. The income statement is made up of revenue minus expenses, and it equals either net income when revenue is greater than the expenses, or a net loss when expenses are greater than the revenue. So we ask ourselves, what is revenue? Revenue is an increase in resources resulting from the sale of goods or services. So it's the selling of an item or the service that you provide in your particular business. Expenses is a decrease in resources resulting of the sale of goods, of services, or provision of services. So when we talk about revenue, we have sales or service. We also might have interest revenue, which is money that's paid on to you when somebody has borrowed money from you. Expenses are made up of cost of goods, salaries, supplies, utilities, rent, are all examples of expenses. When preparing the income statement, we have 2 principles that we need to learn about. And one of those is what we call the revenue recognition principle. The revenue recognition principle, which simply stated, says that you will go ahead and record revenue when earned, and it doesn't matter if you've received it or not. So if you go ahead and mow their lawn and they're going to pay you next week, you're going to go ahead and record that revenue because you've earned it. It doesn't matter if you've received payment for it or not. The second principle that we talk about is what we call the matching principle. And the matching principle is that we want to match revenues when earned with expenses incurred. So that means if I mowed the lawn and they're going to pay me next week, I record that in my accounting records. And I bought gas, but I don't have to pay the bill for 2 weeks until the next month because I bought it on a credit card, I would still include the gas expense, even though I didn't pay for it. So making the actual payment or receiving the actual money in return for the sales does not matter when recording revenue and expenses. You always want to record revenue when earned, whether or not you've received it, and you always want to record expenses when incurred. In other words, when you've made the expense against those revenues that those expenses helped earn. That's very important. So we have revenue, an increase in resources, expenses, a decrease in resources. Revenue recognition, go ahead and record the revenue when you've earned it. And the matching principle, that we're going to match revenue when earned with the expenses that help generate those revenues. Those are the 4 items that come into preparing the financial statement. So when we talk about the income statement, we are in fact using this formula. Revenue minus expenses equals net income. So I'd like to go ahead and demo a problem using an exercise in the book. I'm going to be turning to page 17, number 1. So page 17, number 1. And we're going to go ahead and prepare a income statement using the information in the book. Okay, so we're back. Page 17, number 1. Okay, page 17, number 1. And the problem said, Ted's typing service generated $4,000 in revenue in the month of January. Salaries were $1,500 for the month, and supplies were $200. Additionally, Ted incurred $50 for advertising. So if I was going to go ahead and prepare the income statement, I would go ahead and write income statement. I'm going to go ahead, you always put the name of the company, so this is Ted's typing service, income statement, and then the period of time that it covers. So in this particular instance, they said it was for the month of January, so it would be for the month ending January 31. For the income statement, it's always for what we call a period of time, for the month ending, for the 3 months ending, for the 6 months ending, for the year ending. It's always for a period of time. The first line item here on the income statement is going to be revenue, and in our case, it was $4,000. So we go ahead and we put the revenue, and now we go ahead and list the expenses. And so the first expense we had was salaries expense. And the amount of salaries were $1,500. They then told us that we had supplies expense for $200. And then it goes on to tell us that we incurred, which means we used up $50 of advertising expense, but we didn't pay it. But we get to go ahead and put it in our financial statement, because what we always want to do is tell the most accurate story of a business. That's what financial statements do. They tell a story. In this particular one, we want to make sure that we understand what helped generate this $4,000. We had people who did the work, we had to have some supplies for them, and then we advertised to help generate this $4,000. So we're going to go ahead and include that, even though we didn't pay it. We go ahead and total our expenses up. I'm going to go ahead and put it over here. So we have $1,750. The formula, remember, is revenue minus expenses gives us net income, and we know it's going to be income because the revenue is more than the expenses, and it is more than the expenses. If I do my quick math, $22.50. Let me make sure I do the math on the side. 17 plus 22.50. Yep. Okay. So 22.50. Please double check my math. I don't know if I did that right or not, but I didn't bring a calculator today, so there we are. So 22.50 is our net income. And that is an example of an income statement. It only includes revenue and expenses. Revenue minus expenses equals net income. And that is an income statement. No other accounts or any other type of accounts go on the income statement other than revenue and expenses. Now, let's go ahead and move on to the second financial statement. The reason I call it the second financial statement is we're always going to prepare these financial statements in order. We're always going to begin with the income statement. Now, these two statements aren't going to equal one another because they're not the same company, but it's the format that I'm most intrigued with right now. And so this particular statement is called the statement of retained earnings. And I wrote too big. Statement of retained earnings. It is also done for a period of time. So in this case, if we were preparing this for Ted's typing, which I'm going to go ahead and connect the dots for you, it would be for the month ending January 31. So always for a period of time. And up here, I would do Ted's typing. I'm making this up, so it's nowhere to be found. I'm just making this up to demo a statement of retained earnings. The formula or the format for the statement of retained earnings is this. It's, and I'm going to abbreviate, beginning retained earnings. Okay, so in this case, it would be as of January 1, plus net income, minus something we call dividends. We'll talk about what that is here in a minute, equals ending retained earnings. So this would be as of January 31. Okay? So when we talk about, let's talk about what these words mean, okay? And so the statement of retained earnings for a company shows the change in a company's retained earnings over a period of time. In other words, it talks about how we got our profits and then if we distributed any of the profits and what we have left over. So this is an account that ongoes, that accumulates earnings over time. So if we were doing Ted's typing service, let's just say their beginning retained earnings was 0. We see that their net income is $22.50, and that's why I wanted to do this. This is why you prepare this statement first and this statement second, is because you need the net income. And let's just say, for my example, Ted paid $250 of dividends. Dividends is a distribution of profits to the shareholders. So dividends are a distribution of the profits to shareholders. So in this case, they gave up $250, and so therefore ending retained earnings would be $2,000. Now, if I was going to go do this statement for February, this then would become the beginning February balance, and then you'd come up with a new ending balance. So the beginning retained earnings plus net income minus your distribution of profits, which is what we call dividends, gives us ending retained earnings, and then that becomes the beginning for the next month, for the next period. Okay? This statement of retained earnings actually links the two statements together. It links the income statement to the balance sheet, which is what we're going to go ahead and do here in a minute. But before we go on, I'd like to go ahead and take a look at another problem in the book before we leave, 18, so page 18, and I want us to look at number 5. Look at number 5. And we can go ahead and use what I have here, minus the dates, obviously, but we can use the format or the formula. Okay, so in number 5, it says on page 18, at the beginning of the year, a company has retained earnings of $175. So we're going to fill that in here. During the year, the company generates $110,000 of net income. So they already did that for us. And distributes $10,000 in dividends. okay? Distributes $10,000 in dividends. So then what is the ending retained earnings? It's 175 plus 110 minus $10,000. So in our case, I believe if we do the math, should be 275. Please double check me. So 175 plus 110 equals 285 minus 10 gives us 275. And that's how you prepare a statement of retained earnings. Okay, let's go ahead and let's talk about the third financial statement, which is what we call the balance sheet. Okay, the balance sheet is made up of three sections. One is what we call assets. Okay, and an asset is a resource of the company, or in better terms, an economic resource that is objectively measurable, results from prior transactions, and will provide future economic benefit, which is the definition of an asset from the textbook. In reality, it is just basically known as an economic resource, okay? An economic resource. Now, an asset is a category on the balance sheet. And so assets is the title category. Under assets are some sub-account titles: cash, accounts receivable, inventory, property, plant, and equipment, prepaids, supplies, are all examples of an asset. And in fact, if you go to the back of your textbook, and it should be page 389, there is no page on it, you'll find something that we call the comprehensive chart of accounts. It gives you assets and all different types of assets that are possible. It gives you liabilities, which we'll talk about here in a minute. It gives you equity. We'll also get some clarity on that here in a minute. It also gives you all the types of revenues, which we just talked about on the income statement. And all those items, not total all of them, but it gives you a good selection of those accounts that we call expenses. So revenue and expenses are a major heading. Under it would be all of the items that represent revenue and expenses. So in this case, these are what we call accounts, and they are all assets. So the first part of the balance sheet is also the first part of what we call our accounting equation, which is assets equal liability plus equity. Okay? So when we go ahead and take a look at what a liability is an obligation of a business that results in some sacrifice of these assets. So in other words, in layman's terms, it's money you owe to someone. It's money that the company owes to someone, whether it be a bank, a supplier, employees, government. It's money that's owed to others. If you look on page 389, or that page that should be 389, please note that page of the chart of accounts doesn't have a number on it. Don't ask me why. Examples of liabilities are accounts payable, dividends payable, wages payable, notes payable. So there's a theme, isn't it? And everybody should have just said them to themselves. What is the common theme for each of these accounts? It should be, and you're right, the word payable. Anytime you see the word payable, it's a liability. It doesn't matter what's in front of it here. Anytime you see the word payable, it will be considered a liability. Equity, which is what we're going to move on to now, is the difference between the company's assets and its liabilities. So I could change this and do assets minus liabilities equal equity. I can change that, and that equation would still be true. In our case, for the building of the balance sheet, assets equal liabilities plus equity, and you'll see what I mean here in a minute. So equity, the definition of equity, is the difference between an assets and the liabilities. In other words, equity is the claim of the owners against the company's assets, because we're going to assume the company is going to pay its bills. So after the bills are paid, the equity would be what was left over. An example that I always use in my classes is if in the middle of the room I have $100,000, right? And I owe 50 to assorted people, and they come and they take their $50,000. I have $50,000 left for the rest of us to come and put our hands on. And that is what equity is. So under equity, we have something called contributed capital. Contributed capital, or common stock. That's money that's put in. And we have retained earnings. You should be going, aha, retained earnings. I just saw that on that statement of retained earnings. Well, let's go see how this is all going to come into a good-looking financial statement. So before we do that, I just want to recap that on the balance sheet, you're going to list the assets, the liabilities, and the company's equity, and prepare the balance sheet. An asset is an economic resource of a company. A liability is a claim on those resources. And then the equity is what's left over when you take all your assets and you pay all your bills. It's what's left over to the owners. So we're going to go ahead and learn how to prepare a balance sheet next. All right. And what we're going to do is we're going to go ahead and use an exercise at the end of the chapter. So let's go find out what a good one is here. So let's go ahead and take a look at, I don't have a great one here at the end of the chapter that would make sense to me. So we're going to go ahead and take a look at, I guess the best way to do it would be to go ahead and prepare a series of financial statements is probably the best way for us to go ahead and tie everything all together. And so what I'd like to do is go ahead and use number 26 on page 21. So number 26 on page 21, we're going to do as an example. Page 21, number 26. And what we're going to do is we're going to learn how to prepare a balance sheet, but we're going to do the other statements as well, so you can see how everything links together. And so number 26 on page 21. So page 21, number 26. And why don't you go ahead and get a piece of paper and a pencil or a pen, and let's do this together, okay? And I'll go ahead and pause, hoping that you can go ahead and put this together as well, all right? So they've given us a list of accounts and numbers, and they've asked us, hey, prepare our income statement, statement of retained earnings, and the balance sheet. That's what they want us to do. And I know We haven't prepared a balance sheet yet, but this will be double duty. We'll prepare the balance sheet and link everything together. And so the way that I do these things when I started out, just like you, is I need to take a look at this list and decide which statement they're going to go on. And so what I'd like you to do is go ahead, using the back of the book, that chart of accounts, take a look at these accounts, and if it's a balance sheet account, right next to it, BS, pardon the pun. Then if it's an income statement account, put IS, and then if it goes on the statement of retained earnings, just go ahead and put an R. And in our particular situation, as you look down here, there will be nothing that has an R next to it at our point, okay? So go ahead and take a minute, and then we'll review it together. So if it goes on the balance sheet, put BS next to it. If it goes on the income statement, put an IS. And then obviously, if you had something for the statement of retained earnings, you would put that on there as well. Okay? So go ahead and take a minute, and you can go ahead and use the back of your book there, page 388, 389. And I'll go ahead and just take a minute here. Okay, so let's go ahead and see if you got those right. So accounts payable is a balance sheet. Anytime you see the word payable, it means it's a liability. Accounts receivable, that's also true. Anytime you see the word receivable, it will always be an asset. Whether it's interest receivable, notes receivable, accounts receivable, it's always an asset. So anytime you see the word payable, it's a liability, which is a balance sheet account. Anytime you see the word receivable, it's an asset, also a balance sheet account. So the first two are BS's. Anytime you see the word expense in this particular case, advertising expense, other than if it's prepaid expenses, that would be an income statement. So that's an income statement. Buildings are equipment, property, and plant, so that's a balance sheet account. Contributed capital is a part of equity, again, a balance sheet account. Cash is an asset. Notes payable, a liability, so both cash and notes payable are balance sheet accounts. Salaries expense is an income statement account. Service revenue is an income statement account. And equipment is a balance sheet account. So we're going to go ahead and pull the income statement accounts first and prepare the income statement. Again, it's the income statement, and it's for Honky Tonk Records. And it's for the year end, so for the year ending, and we can pick whatever year we want. We're going to go ahead, remember on the income statement is only revenue and expenses. So our revenue is $16,820. We're going to go ahead and subtract our expenses. In our case, we had advertising expense, and I'm abbreviating advertising and expense, and that happens to be $6,000. Our next expense is salaries expense. So in this case, we only have two expenses, and that is $9,500. So we're going to go ahead and total expenses. So $15,500 minus $16,820. So $15,500. So that gives us net income of 0, 2, 3, 1, 1,320. So hopefully I've done the math right on that. You might want to double check me. So now we've completed the income statement. Second statement that we make is the statement of retained earnings. Okay. Again, honky tonk records. Okay. Also for the year ending, whatever the year ending is. Okay. We're always going to begin with beginning retained earnings plus net income minus dividends equals ending retained earnings. So in this particular case, there is no beginning retained earnings, it doesn't look like. Okay. So this would be 0 beginning. Our net income is the $13.20 from the income statement. They don't give us any dividends, therefore the ending retained earnings is $13.20. So they didn't pay any distributions, which means in our case here, the ending retained earnings is $13.20. Rarely will it be the same as the net income, but that could happen if you're just starting out as a new company. Okay? So the next statement that we're going to do, I'm going to demo, is the balance sheet. Okay, this is the balance sheet. And there is a slight twist here. The balance sheet is done for a point in time. So here was for a period of time. The balance sheet is for a point of time, as of December 31st, as of June 30th, where this is for a period of time, this is done for a point in time. So I'm going to go ahead and put as of December 30th first. Okay. Now the balance sheet has on it assets, okay, liabilities, okay, and equity is all on the balance sheet. So what we also know is that assets, so we're going to total that, total assets equal liabilities and owner's equity. So let's go ahead and pull those accounts off that we deemed as balance sheet accounts and which one would be an asset. So if you look at your cheat sheet on the back of the book, accounts receivable is one, which is $21,000. Cash is another one. Cash always goes first, even though they don't have it in order. Cash is always your first account on your balance sheet. What you like to do for the balance sheet is list the accounts as far as how liquid they are, which means how quickly can you make them into cash. The ones that can become cash fairly quickly, then those are going to go first. So obviously cash will always be first. Accounts receivable is where you have sold somebody an item or a service and they're going to pay you later. So it's when somebody owes the company money for sales or service. We call that accounts receivable. Okay? Next, we have buildings. And the buildings are $76,000. And I'm kind of checking them off as I go here to make sure I pick everything up. And then we have equipment. All of these are examples of assets. How do you get to know that? Practice, practice, practice. Okay? So that's equipment. Now we're going to list the liabilities. So we have accounts payable, and the accounts payable is $27,000. Okay? Do we have any other? We have notes payable. I'm abbreviating. So we have notes payable, which is $70,000. And then under equity, we have contributed capital, which is $30,000. And in a few weeks, you'll know these by heart. And we also have retained earnings. Okay? So then the total liabilities and equity, we're going to total those. Okay, so let's go ahead and total the assets. So we have 70,000, because I think we've picked them all up now. There's nothing left in the list that they gave us. So assets, we have 91,000, right? 70 plus 21 gives us 91. Really should have done so we have 91 plus 76 gives me 7 and 6, right? 9 and 9, 9 and 7. Yeah, so 167 plus 25,000 plus 25 is 192,000. Please, let's check the math. I might do that before we finish. 192, okay? So what we know, based on the formula for a balance sheet, which is assets equal liabilities plus equity, okay? So we're going to add these up. Here we have 77,030, but what we don't have is they didn't give us retained earnings. And that's because we have to get it from the statement of retained earnings. So we're going to put 1320 here, okay? That's why we prepare the statements in order. First, the income statement, so we then can have the net income number to populate the statement of retained earnings. And then we prepared the statement of retained earnings so we can have that number to link in to the balance sheet. And so the balance sheet ties these two statements all together because we know that we made 1320 in this particular year. So let's quickly add these up. So I have 97, right, plus 30, which is 127, plus 1320. So obviously, I have done my adding and subtracting incorrect. So let me go ahead and grab my calculator. You guys can too. I'm sure you're already doing it and going, oh my God, oh my God. So let's go ahead and add this all together, okay? So I have 70,000 plus 21,000 plus 76,000, yeah, plus 25,000, plus 25,000 is 192. So I did do the math right. So accounts payable is 21, accounts receivable 21, 27 is accounts payable, notes payable is 70, contributed capital is 30. Something doesn't seem right. Maybe it's my revenue. So 16,820 minus 9,500 equals 7320 minus 6. So these numbers check out, okay? Maybe I missed something over here. No, statement of retained earnings and balance sheet. So I have to make sure I'm adding things correctly. So, I know cash is only 6320. This is a very important lesson. We know that assets have to equal liabilities plus equity, so therefore we had an error somewhere, and that's what I'm working through. So this is I picked up the wrong number, and so that's supposed to be 6320, and believe me, this will be happening to you as well. So I kind of did this like the mad scientist because I wanted us to be able to figure out why we didn't balance. So you see how I did that? I went back through everything knowing what I know, 6320 plus 21 plus 76 plus 25 equals 128,320. And when we go down and we add the liabilities, the 27,000 plus the 70 plus the 30 plus the 1320, we get 128,320. So, hence, a balance sheet. We are in balance. Your total assets must equal your liabilities and your equity. That is the formula for your balance sheet. The formula for retained earnings is beginning retained earnings plus net income minus dividends equals ending retained earnings. The formula for the income statement is revenue minus expenses equals net income. And those are the three financial statements. There is a fourth financial statement, what we call the statement of cash flows, which you will learn in the Accounting 220 class if you go on. I actually feel that the statement of cash flows, which we used to call the statement of sources and uses, is one of the most valuable financial statements for a company, especially if you're an owner of a company, because it shows you how you used your cash. But for right now, we're just going to be responsible for these financial statements. And so our main takeaway today needs to be there's three financial statements. You prepare them in order. The income statement goes first. The statement of retained earnings goes second. And the balance sheet goes third. The only accounts that go on the income statement are revenues and expenses, and this is the formula for that. On the statement of retained earnings, you have beginning retained earnings plus the net income from the balance sheet minus any dividends, gives you ending retained earnings. On the balance sheet, you're going to list all of those accounts you deem as an asset first, always starting with cash, and then going down as far as liquidity goes. You'll then list all of your payables or your liabilities, and then your equity accounts are contributed capital or common stock plus retained earnings. Those two items, liabilities plus equity, must equal your total assets. If they do not, you need to go find out why, just like you and I did. We had 197 here and 128,320 here, and that's because I wrote down the number wrong. Simple things like that happen as we go. And so now it's your turn to go try your hand at creating financial statements, as well as understanding the theory that makes the financial statement. So you're going to find some exercises where some of these numbers might be left out. Well, knowing that they have to equal them, you're going to have to work backwards and forwards and try and find them. And then you might have something missing, and you might have to go back and fill those in to link the statements now that you understand how to prepare them. So now it's your turn.